Welcome back to Financial Management. My name is Miriam and I'm going to be going through part 1, Financial Institutions, of our banking lesson. I know a lot of folks are skeptical of large institutions like banks, and there's totally valid reasons for being wary of putting your money in a large institution like a bank. You're an adult and this will be your decision to make in the end, but we wanted to provide some information about different kinds of financial institutions. We'll be going over traditional banks, credit unions, and online only. First, we'll talk about the differences between banks and credit
unions. When it comes to opening up a new bank account, you have two choices on where to do it, either at a bank or a credit union. But what's the difference? Well, it boils down to 3 simple O's: ownership, objective, and operation. Let's take a closer look. The first difference is ownership. Banks are owned by shareholders, whoever that might be. Credit unions, on the other hand, are owned by customers, or as they call them, members, and they're part of a cooperative. They may have a common theme together, like they may all be firefighters or live in a certain part of town. In fact, members have a say in the way that the credit union is being operated. If they don't like it, they can run for the board of directors to make a change. Try that with your bank. The second difference is objectives. Both banks and credit unions have the objective of serving the financial needs of their customers, but banks need to maximize profits for its shareholders, whereas credit unions are not for profit. After covering their expenses, they return their profit to their members in the form of lower loan interest rates, higher savings account interest rates, and lower or fewer service fees. The final difference is in operations, or the way they operate. Both banks and credit unions have ATMs, branches, deposit insurance, and are overseen by regulators, but that's where the similarities end. Banks oftentimes try to sell themselves as a convenient one-stop shop. They want to take care of your entire financial life in-house. On the other hand, credit unions try to compete on service. They're oftentimes smaller and locally controlled, so there's more opportunity to build a relationship. And that's important when it comes time for a loan. But don't confuse their smaller size with a lack of convenient banking options. A lot of times credit unions are part of a shared branch or ATM network, so you can bank at other credit unions across town or around the country. So when you boil it down, both banks and credit unions try to offer the same products and services, just in a little bit different way. So in 2 minutes, you just got smarter about the difference between a bank and a credit union. For more information and resources, visit our website at 2minutefinance.com. I'm Bobby Lee with 2 Minute Finance. Thanks for watching.
We're now going to review the information presented in the video. Feel free to take out your financial management binder and fill out the handout as we go. So first off, ownership. Who owns a credit union versus who owns a bank? For credit unions, members are the account holders. You, if you have an account at one, own the credit union, whereas banks are owned by their shareholders. What is the goal of a credit union versus a bank? Credit unions are not-for-profit organizations who, after they pay their expenses, pass along the extra income to their members. You'll see this not as an extra paycheck, but through lower interest rates on loans and higher interest rates on savings accounts. Banks pass along any extra profit to their shareholders, who are not necessarily those who have accounts at the bank. In terms of operations, credit unions are smaller and more local, whereas banks tend to be national or international. Think of a credit union as your favorite neighborhood bodega, and a bank as a Walmart or a Target. Despite these differences, there are ways that credit unions and banks operate very similarly. You can have a checking and savings account at both of them. Both of them issue loans for cars and apartments. Both have online banking and mobile banking that you can access through your computer or phone. Both are federally insured, meaning that your money is safe there. And both have nationwide ATM networks so you can access cash when you need it. Now we're going to talk about brick and mortar versus online only. Brick and mortar is what you think of as your traditional bank. It has local branches that you can stop by and talk to a teller in person to help you with a number of things. Some of the most common ones are listed below with their logos. Online-only banks are relatively new with the rise of the internet. These banks have no physical locations for you to walk into and can be accessed only online, but you can access them anytime on your computer, tablet, or phone. And in some ways, they offer more convenience. How do you know which is right for you? If you need certain specific banking services like a safe deposit box or prefer one-on-one in-person help, then a brick and mortar bank might be the way to go. However, they tend to have higher fees and lower interest rates because they have to pay rent and more employees. If you are okay with limited services and don't necessarily need to talk to somebody in person, then you may want to consider an online-only bank. Because they don't pay rent or as many staff members, they tend to have lower fees and higher interest rates. However, you can't jump straight into an online-only account. Because there's no way to deposit cash directly into an online-only account, you must first open an account at a brick and mortar bank. You can then transfer your funds from one account to another or even across banks. Thanks for following along with this lesson. To get credit for completing the lesson, go back to the Google Classroom and submit the assignment. Please write a few sentences explaining which type of financial institution you think is the right choice for you and why. Remember, you have not actually completed this lesson until you've submitted the assignment.